Picture this. You're watching your screen, green candles climbing, your position is showing a 15% gain. Your heart starts racing. The voice in your head whispers, "Take it now before it disappears." But another voice argues, "This could go much higher." Your finger hovers over the close button, paralyzed by fear and greed. Sound familiar? You're not broken, you're not weak. You're simply human, experiencing one of the most psychological challenges in trading. Now, I've worked with traders across the globe over the past 12, 13 years, and I can tell you with absolute certainty, profit-taking anxiety exists. And the irony is that the very moment you should feel confident, when you're actually making money, becomes your greatest source of stress. Your brain is designed to keep you safe from these prehistoric threats. It doesn't distinguish between a saber-toothed tiger and a floating profit that might disappear. Both trigger the same fight or flight response that can sabotage your trading success. Today, we're going to dive deep into these challenges, explore the real cost of poor profit-taking decisions, and most importantly, equip you with practical strategies that will transform your relationship with profitable trades forever. Let's dive in. Now, when you're sitting on a profitable trade, your mind becomes a battlefield of competing psychological challenges. Understanding these challenges is the first step towards mastering them. Now, traders can sell winners at, say, a 50% higher rate than losers. This might sound like rational behavior until you realize that this often happens precisely at the wrong time. Now, we're programmed to book profits too early and hold losses too long, the exact opposite of what successful trading requires. Now, the effect reveals that people dislike losing. Traders do not like losing. It's a fact. And significantly more, they enjoy winning. Now, your brain processes the pain of losing £100 or dollars with roughly 2.5 times the intensity of gaining $100 or pounds. Now, when you're holding profits, your unconscious mind isn't celebrating, it's terrified of the regret you'll feel if the profits disappear. This creates a perverse psychological trap. The fear of losing money makes you more likely to lose money. Your brain treats unrealized profits as already yours, and the thought of losing them feels like theft rather than normal market fluctuation. Now, once you own a profitable position, you value it more highly than you did before entering the trade. The psychological ownership makes it incredibly difficult to let it go, even when logic should suggest you should. You start to identify with the position, making closing it feel like a personal loss rather than a business decision. Now, research shows that this effect becomes stronger the longer you hold a position. The more time and emotional energy you've invested, the harder it becomes to make objective decisions about when to exit. Your memory doesn't work like a video recorder. Instead, you remember experiences based on their peak intensity and how they ended. So, if you've previously closed positions too early and watched them continue climbing, your brain files this as a traumatic memory. This creates a powerful bias against taking profits, even when your original analysis suggested that the current level would be a reasonable exit. Now, can you see how this works? When you see your position hit a new high, that becomes your new reference point. Suddenly, a 15% gain doesn't feel like a success. It feels like a 5% loss from the peak. This constant readjustment of your mental reference point makes it virtually impossible to feel satisfied with any level of profit. When profits are running, you're caught between the hope that they'll continue growing and the fear that they'll disappear. And I'm sure you've all experienced this at some point. Now, this emotional swing creates decision paralysis precisely when you need clarity the most. The key is developing systematic approaches that work with your psychology rather than against it. The numbers don't lie here, and they paint a truthful picture of how psychological biases, particularly around profit taking, can destroy your trading wealth. So it's around only 3% of day traders make a profit, and only 1% do so predictably. Even more telling, the day trading success rate for those who were slightly profitable but couldn't make enough to live off was likely to be around 10 to 15%. At least 64% of day traders in studies lost money, suggesting that it's more difficult to be a profitable trader than the industry maintains. Now, the average individual investor underperforms a market index by 1.5% per year. And this is just sort of estimated figures here, whilst active traders underperform by 6.5 annually. This isn't a small difference. Over a 20-year period, this performance gap represents hundreds of thousands of pounds in lost wealth for the average trader. This is huge. One of the most important statistics trading to learn is no more rational or profitable than playing roulette to learn for the individual investor. Now, the data shows that most people who get into day trading believe they'll be better than average, but virtually all of these traders are wrong. Professional traders often have winning percentages in the range of, say, 50 to 55%, maybe more, which might seem surprisingly low. However, their success comes from disciplined profit taking and loss, cutting, not from being right more often. Now, successful short-term options traders are correct on roughly 35 to say 40% of their trades, yet they achieve profitability through superior risk management. Now, research shows that you can make money with more losers than winners by averaging, say, 1.1% for each winning trade, letting winners run, while keeping the average loss at a minus 55%. Now, again, these are just estimated figures here. Now, these statistics aren't meant to discourage you. They're meant to just show you how crucial proper profit-taking psychology is to your success. Understanding this gives you a massive edge over the majority who remain unaware of these psychological challenges. So, let's talk about building confidence in your decisions. Now, confidence in trading isn't about being certain of outcomes. It's not that. It's about being certain of your potential and your process. The most successful traders or consistent traders combine, say, a systematic approach with deep self-awareness to make decisions that they can stand behind regardless of individual results. True trading confidence comes from knowing that your decisions are based on good principles and a good plan rather than your emotional reactions. This means developing and following a good systematic approach to your profit taking incorporates both technical analysis and risk management principles. So, when you have a clear framework and structure for your exit decisions, you start to remove the burden of having to make perfect predictions about the market direction. Instead, you focus on following a process that gives you an edge over many trades, knowing that individual outcomes will vary, but long-term results will be positive. Developing confidence requires creating specific written rules for different market scenarios. So this means your playbook should address questions like, how do you handle profits when markets are trending strongly? What's your approach during volatility? How do you adjust your exits based on the time of day or even upcoming news events? Now, this playbook becomes your decision-making compass during emotionally challenging moments. It helps to really anchor you. So when fear starts influencing your thinking, you can refer back to decisions you made during calm and rational moments. So the power of backtesting your exit strategies. The most successful traders I know, they spend time backtesting. It gives them knowledge and it's important. So confidence grows when you have evidence that your approach and strategy work. This means testing your exit strategies on historical data to understand the performance. What's the average profit when you exit at the first target? How often do trading stops get hit versus profit targets? What happens when you hold through minor pullbacks? Now, when you know that your exit strategy captured, say, 75% of available profits in trending markets, you can stick with it during the 25% of times when it feels like you're leaving money on the table. Confidence is much easier to maintain when you're not risking money you can't afford to lose. Proper position sizing ensures that no single trade, regardless of how it exists, can significantly damage your account or emotional well-being. When the financial stakes are manageable, you can focus on executing your strategy rather than worrying about the consequences of simply being wrong. Now, many traders struggle with exit decisions because they're risking too much on individual trades. When 5% of your account is on the line, every profit-taking decision feels monumental. When it's 1%, you can follow your plan with much greater emotional ease. And again, it comes down to self-awareness. Really tune in with how you're feeling with different figures. Now, there's a delicate balance between having enough confidence to follow your plan and being so confident that you become rigid and unable to adapt to changing market conditions. The healthiest form of trading confidence includes a balance of kind of humility about market unpredictability and an openness to refining your approach. This balanced confidence allows you to stick with profitable strategies during even drawdown periods, whilst remaining alert to signals that your approach might need adjustment. It's confidence in your ability to adapt and learn, not confidence in being able to predict every movement. That's the secret formula. So, your path to profitable exits. Now, conquering profit-taking anxiety isn't about eliminating emotions. It is about creating systems that work despite your emotions. The most successful traders, they're not emotionless. They're not robots. They're humans who have developed robust processes that guide their decisions even when the pressure peaks. Now, remember, every trader has faced the same struggles you're experiencing now. And the good news is you can overcome these psychological challenges. Start with small position sizes if that helps. Build your confidence through repetition and analysis of your results. Focus on following your process rather than the outcome. More importantly, be patient with yourself. The tools and techniques outlined in this presentation have helped so many traders, and you don't need to take all of them on board, but just a few things can really help you to get to a position where you can overcome and just allow your winners to run. Your future trading success depends on your ability to manage your own psychology during trading. Master this and you'll join the small percentage of traders who consistently extract profits from the markets. The path forward is clear, and I wish you all the success. Until next time. Thank you. Now that we understand the psychology and statistics, let's examine the specific mistakes that cost traders the most money. Recognizing these patterns in your own behavior is a first step towards breaking free from them. So the first one is, and the question is, how many times have you closed a position simply because it hit a nice round number? Now, I know many traders who have done this, whether it's $1,000 profit or 50 pips or 100 points. These numbers have no technical or fundamental significance. They're purely what we call psychological constructs. Yet traders regularly abandon well-reasoned exit strategies to book profits or to take profits at these levels. Now, this mistake stems from what psychologists call numerosity bias, our brain's tendency to find certain numbers more satisfying than others. Now, the problem is that the market doesn't care about these preferences. So the second, what we call mistake, is perhaps the most common and costly mistake. So, for example, you enter a trade with a clear plan. You take profits at, say, the 1.618 Fibonacci extension, or when RSI hits 80, or at the next major resistance level. But as the trade moves in your favor, doubt creeps in. Maybe I should just take what I can get. While this sounds prudent It's actually a wealth-destroying mindset. So, mistake number 3 is partial profit taking. This could be a useful tool, but too many traders use it as an emotional crutch rather than a strategic decision. They take maybe a bit off whenever they feel nervous, gradually eroding their position size until they're left with a meaningless remainder. Now, this approach often results in closing the entire position at the worst possible levels. The fundamental problem with emotional scaling is that it's driven by fear rather than market analysis. Now, the next one, number 4, trailing stops. Now, trailing stops can be an excellent tool when used properly, but they're often implemented as a psychological band or band-aid rather than strategic instruments. Traders set them too high out of fear, ensuring that they get stopped out on minor pullbacks, or too loose out of greed, negating their predictive benefit. Now, the key insight is that your trailing stop distance should be based on market volatility and structure, not on your emotional comfort level. Number 5, this might be the most damaging mistake of all. So you become fixated on the peak profit new trade reached, treating any decline from that peak as a loss rather than normal market movement. If your trade hit, say, $2,000 profit and is now showing $1,500, you feel like you've lost $500, even though you're significantly ahead. This peak obsession is what we call it, creates an effect where you can never be satisfied with any profit level. And this is very common for traders. So, number 6, you're holding a profitable position when suddenly there's news on earnings announcement, economic data, or even a central bank statement. Panic sets in. What if this news moves against me? You think, and you close a position immediately, regardless of your original plan or the actual content of the news. So, number 7. Life happens, bills are due, opportunities arise, and emergencies can happen. Suddenly you need to access some money tied up in your profitable trade. So you close it, regardless of the technical picture of your original plan, because any profit is better than losing. Now, trading with money you might need for other purposes guarantees that your decision making will be compromised. And it will be compromised by external pressures rather than your analysis. So the last mistake it's called the platform paralysis. Now, trading platforms offer numerous order types and automated features that could help with profit taking, but many traders never learn to use them effectively. They stick to basic market orders and manual monitoring, ensuring that their emotional state at any given moment is the primary factor in their exit decisions. Now, when you recognize these mistakes in your own trading, it can feel uncomfortable, but it's essential for your growth. Now, the good news is that every one of these mistakes has a solution, and we'll talk about that further on. So, practical tools for overcoming hesitation and self-doubt. Moving from understanding to action requires practical tools that you can implement immediately. These techniques address the specific moments when hesitation typically strikes. It provides concrete steps to maintain objectivity during emotionally challenging situations. So, the first one is the pre-trade exit plan protocol. We'll call it that. Now, before entering any trade, write down your specific exit plan using the if-then format. For example, if the price reaches 2 times ATR and RSI exceeds 80, then I will close 50% of the position and trail the remainder with a 1.5 ATR stop or 1.5 times ATR stop. This removes in the moment decision making and emotional interference. So whatever your trading plan and your risk management, just adopt it to different scenarios. Vague plans like take profits when it feels right just don't work under pressure. You have to be very clear about the different scenarios before you start your trading session. The more prepared you are, the better it's going to help, and the less decisions that you need to make in your trading session, the better. So the next one is the 5-minute rule for emotional interference. So this means when you feel the urge to deviate from your exit plan due to emotions, implement a mandatory 5-minute cooling off period. So maybe you want to set a timer and step away from your screen. During this time, write down what you're feeling and why you want to change your plan. Often, simply articulating these emotions reduces their power over your decision making. It's like what we call breaking your state. So if after 5 minutes you still believe your plan should be modified, you can make changes. But they must be based on new market information, not your emotions. Now, the next one is the alert-based exit system. Rather than constantly monitoring your profitable positions, set up alerts at your kind of exit levels and then close your trading platform. Now, these are just suggestions. You don't have to follow them. They're just things that are techniques and practices that could potentially really help. So what this does, or what this can do, is remove the pressure of watching every price movement and eliminate the temptation to make fear-based adjustments to your plan. It's very, very common traders do this. Now, trading platforms offer, or some trading platforms offer, sophisticated alert systems. This can help you monitor multiple conditions at the same time. Use these tools to automate the monitoring process while keeping yourself removed from the emotional intensity. Now, the next one is the profit protection ladder. So for longer term traders, you can implement an approach to protecting profits as they accumulate. So for example, at 1 hour profit, move your stop to break even at 2 hour profit. Move your stop to 1 hour profit at 3 hour profit. So these are just suggestions depending on your plan. Now, the ladder should be designed during calm moments and followed systematically during live trades. The next one is the reality check questions. What does this mean? Well, when hesitation strikes, ask yourself these specific questions. Has my original analysis changed? Am I afraid because of new market information or just because I have profits? If I was entering this trade fresh today at current levels, would I take it? These questions help distinguish between rational concerns and emotional, what we call interference. Write these questions on a card and keep them visible during trading hours. The act of reading and answering these often clarifies whether your hesitation is based on analysis or emotional reaction. So the next one is the visualization technique, which I've talked many times about in different video presentations. So before the trading day begins, visualize yourself successfully and calmly executing your exit strategy or your exiting trades. See yourself calmly following your plan when profits reach your targets. Imagine the satisfaction of executing your strategy regardless of what happens afterwards. This mental rehearsal or visualization is going to prepare your mind for successful execution under pressure. The more you do it, the better it's going to work. It's about consistency, like trading. So the last one is the technology leverage strategy. Use your trading platform's automation features to remove emotional reactions when you can. Now, you don't have to do this, they're just suggestions, but it will help take the emotional edge off. So you can set up things like conditional orders that execute your exit strategy based on your plan. And this ensures that your logical pre-trade thinking governs your exits rather than in the moment emotions. So we're going on now to talk about your path to profitable exits. So your path to profitable exits. Now, conquering profit-taking anxiety isn't about eliminating emotions. It is about creating systems that work despite your emotions. The most successful traders, they're not emotionless. They're not robots. They're humans who have developed robust processes that guide their decisions, even when the pressure peaks. Now, remember, every trader has faced the same struggles you're experiencing now. And the good news is you can overcome these psychological challenges. Start with small position sizes if that helps. Build your confidence through repetition and analysis of your results. Focus on following your process rather than the outcome. More importantly, be patient with yourself. The tools and techniques outlined in this presentation have helped so many traders, and you don't need to take all of them on board, but just a few things can really help you to get to a position where you can overcome and just allow your winners to run. Your future trading success depends on your ability to manage your own psychology during trading. Master this and you'll join the small percentage of traders who consistently extract profits from the markets. The path forward is clear. And I wish you all the success. Until next time, thank you.